In these conditions, the stock price is less likely to rise above the strike price of the call options, allowing the seller to retain the stock and collect the option premium. In strongly bullish markets, however, the potential for higher stock profits may be limited. Covered calls are most effective in flat or slightly bullish markets. In these conditions, the underlying stock is less likely to experience a significant increase that would lead to the option being exercised. This strategy is less suitable in strongly bullish or highly volatile markets, as the potential for the stock to rise significantly above the strike price increases, which could lead to the call option being exercised. What risk is associated with the covered call strategy? The risk associated with the covered call strategy involves balancing stock ownership and option risks. While the strategy offers premium income, there is a risk of the stock being called away if its price rises above the option's strike price. Additionally, if the stock price falls significantly, the premium income may not offset the capital loss. While selling a covered call limits the downside risk to the extent of the premium received, it does not eliminate the inherent risks of owning the stock. If the stock price falls significantly, the losses may far exceed the income received from the option premium. Additionally, there is an opportunity cost if the stock price rises well above the strike price, as the stock may be called away. What potential rewards can be expected from a covered call? The potential rewards from a covered call include regular income from premiums with limited capital gains. The strategy provides a steady income stream through the collected premiums, but limits the upside potential if the stock price rises significantly beyond the strike price of the call option. The primary reward of a covered call strategy is the income generated from the option premiums. This strategy provides regular income if the options expire worthless, allowing the trader to sell options repeatedly. However, the trade-off is limited capital gains on the stock. If the stock price rises above the strike price, the trader may miss out on these additional gains. What are the key implementation steps for a covered call strategy in stock options trading? Key implementation steps for a covered call strategy include selecting the right stock, choosing an appropriate strike price and expiration date for the call option, and executing the strategy by selling the call option while owning the underlying stock. Monitoring market conditions and managing the position as needed are also important aspects of this strategy. Implementing a covered call strategy involves holding a long position in a stock and having a thorough understanding of its performance and market trends. Choosing the right call option to sell, typically one with a strike price above the current stock price and with an expiration date that aligns with the trader's income goals. Selling the call option and receiving the premium, which is income for the trader. Monitoring the stock and the market to manage the position, especially as the expiration date approaches. Being prepared to sell the stock if it exceeds the strike price or to buy back the option if market conditions change significantly. A covered call strategy in stock options trading requires a balanced approach, considering both the benefits of premium income and the risks associated with the underlying stock. Traders implementing this strategy should have a clear understanding of their income objectives, risk tolerance, and the market dynamics of the stock involved. Let's talk about protective put to speculate in stock options. In this strategy, an investor buys put options for a stock they already own. The put option acts as insurance, protecting against a significant drop in the stock's price. What is the strategic goal of the protective put strategy in stock options? The strategic goal of the protective put strategy in stock options trading is hedging against a decline in stock value. By purchasing put options, investors can protect their stock holdings against potential losses, effectively ensuring the value of their stock position. The primary goal of the protective put strategy is to hedge against potential losses in the value of a stock that an investor already owns.